Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation. Practical Question 5. AB Limited is planning to acquire and absorb the running business of XY Limited. The valuation is to be recommended based on the recommendation of merchant bankers, and the consideration is to be discharged in the form of equity shares issued by A Limited. So, exchange of shares is happening in this acquisition. As on 31/3/2006, the paid up capital of AB Limited consisting of 80 lakhs shares of 10 each. The highest and lowest market quotation is 570 and 430. For the purpose of exchange, the price per share is to be reckoned as the average of highest and lowest. So for exchange price calculation, they have told take the average of last 6 months, which is 570 and 430. So 570 plus 430 divided by 2 will give us the exchange price, which is nothing but 500. Then XY Limited's balance sheet is there. Share capital, loans, and then assets are there. Okay, an independent firm of merchant bankers engaged for the negotiation have produced the following estimate of cash flows. So one is net asset method, wherein the net assets divided by share will give us the business value. Another thing is future cash flow discounting method. Future cash flows will be discounting to the present value, then that will be the value of business. So merchant bankers given the cash flows. Okay, for 2007, 8, 9, 10, 11, 5 years they've given, and the present value for 5 years also given. It is the recommendation of merchant banker that the business of XY Limited may be valued on the basis of average discounted cash flows at 8%, which is nothing but discounting at this rates for the cash flows, and net asset value method. So average of both. So we have to find out net asset value method also, net asset value also, and then discounted cash flows also. Then average it off. Okay, first we know the exchange price 570 plus 430 divided by 2, and even the requirements also. Total value of XYZ Limited, the number of shares to be issued to AB Limited, then the basis of allocation of shares uh, among the shareholders of XYZ Limited. We'll go one by one. First, total value of business of XYZ Limited. They told it is average of future discounted cash flows and net asset method. So the discounted cash flow nothing but multiplying these cash flows with the relevant year's present value factor will give us the total rate. So 592.4 in case of discounted cash flow method. Net asset value, so the total assets is 350 minus the 100 loans we have, so will give us the net assets. So 250 is the value as of using net assets method. Now average of this is 421.2. So this is an acquisition, so 421.2 is the value of XY Limited, and that will be the purchase consideration also. But for this purchase consideration, how much shares of AB Limited is given, because they told the discharge is in the form of equity shares. So of AB Limited will not be giving money worth of 421, but will be giving its own shares to acquire XY Limited. So we know the exchange price is 500. So this 421.2 crores divided by 500 will give us the number of shares of AB Limited to be given to acquire XY Limited. Okay, so that will be 421.2 divided by 500, 84,240 shares of AB Limited has to be given. Okay, so now we got the total value of business that we know 421.2, and the number of shares to be issued also we know 84,240. Now what is this basis of allocation of shares among the shareholders of XY Limited, and why it is relevant for this question? If we notice the XY Limited's balance sheet, there are two series of equity shares are issued, two classes of shares. One is 20 lakhs equity shares, 10 each fully paid. Then 10 lakhs equity shares of 10 each, only 5 rupees is paid up. So it is partly paid up shares, and then balance 5 rupees is not called off. Okay, so we need to calculate the equivalent shares, because let's say 20 lakh equity shareholders has fully paid up, and they've given the entire money to the company, and they become the owners to that extent of their full shares. But in case of this 10 lakh shareholders, only 5 rupees they have paid. Their liability is still paid, still pending to the company, that they are yet to give the 5 rupees to the company. So it is not correct to give them equal number of shares of AB Limited, because they have paid only the half portion. So we have to find out the equivalent shares. There are two ways. Either we have to convert this partly paid into fully equivalent numbers. Nothing but 10 lakh into 10 will give us 100 lakhs, but divided by 5 will give us the half, which is nothing but 50. So 20 plus 5, because 5 lakh equity shares is the equivalent number to that extent. So 20 plus 5, or if we convert the above 20 lakh into 5 each kind of way, so 20 into um, 20 into okay, if we divide it by 5 will give us 40. Okay, 40 equity shares plus 10, so which will be 50. In both the ways we'll get the answer. Now in this ratio we have to proportion and give the number of shares. We know that 84,240 shares of AB Limited is to be given to acquire XY Limited, but the ratio will be in this ratio because there are two classes of shares, one is fully paid up and one is partly paid up. If we do in this 20 plus 5 also will give us the same answer, 40 plus 10 also will give us the same answer. I have done ICAI is given 20 divided by 25, then the rest will be given to the other class, right, party paid up. So they have just reduced this 67,390 from the 392 from the 82 84 240, or we can do like 84 240 multiplied by 5 by 25 also will give us the same answer. And in this 40 plus 10, that also will give the same answer. Thank you.